For more, let's bring in David Rosenberg from Rosenberg Research and CNBC senior economics reporter Steve Leisman. First, Steve, the market reaction. It was pretty sharp. You saw it in Treasury yields. The dollar jumped. Stocks fell. Tell us exactly what Powell said and didn't say to create the big move.
You know, I think the didn't say is probably the more important part of this, Sarah. What I think happened here is you heard those comments that he made about inflation. And really, I think the market had some expectation in there that the Fed would have its back when it came to inflation rising and yields rising. And there has been this gathering momentum of commentary out there, Sarah, that the Fed was going to step in and enact some form of action to control yields on the long end. All of my reporting suggests that's not the case, that Powell does not want to do that, and he doesn't have the support of the board or the committee to do such a thing at these levels, that 150, 155, even 160. The Fed expects yields to rise. The market, however, wants protection from the Fed when it comes to inflation and higher yields. Powell didn't give it today.
Well, I guess, David, the market has been conditioned to get support from the Fed and has been very harmonious with the Fed throughout this whole journey. Now, are the market and the Fed on different pages?
Well, I think that I don't know if they're on different pages. Look, all Powell said on inflation was he paid lip service to base effects, which I think even teenagers know, and that we might get some temporary pass-through. I don't believe for a second that Jay Powell has some big inflation view or sustained inflation view in his forecast, or really anybody else's at the Fed. The new piece of information today was what he said about how concerned he was with this backup in Treasury yields. When he said that it'll be a concern to him when we have a more generalized backup in interest rates across the economy. So what hasn't happened yet, because of course everybody focuses on what's happening with Treasury yields, but that's not the only interest rate. Or is it the interest rate that necessarily matters for the equity market per se? He's really saying, I will start to get worried about the backup in Treasury yields once it starts to facilitate its way into widening credit spreads. And so the story that doesn't get told is that even with this massive backup in Treasury rates, high yield spreads have barely budged. Investment grade spreads have barely budged. So he's looking at this backup in market rates in the Treasury market in the context of what's happening to overall financial conditions, which haven't really tightened. So at some point, if the equity market continues to correct and it seeps into a deterioration in the credit markets, and you start seeing backup in high yield rates and in investment grade rates, they'll probably step in at that point. At what level? Who knows? But I think that was the new news today, is that he's not going to step in to cap this run up in bond yields until it manifests its way into wider credit spreads. That's my reading of the situation.
Shepard Smith here. Thanks for watching CNBC on YouTube.